You've heard of Bitcoin, you've seen Ethereum explode, but there's a quiet revolution happening right now, one you might not even notice until it's already changed your life. It's called the stablecoin, and in 2025, it's not just some crypto side hustle. It's how people are getting paid, how they're paying rent, how they're sending money to family across borders in seconds. No middlemen, no banks, no delays. And if you're not using stablecoins yet, you might be falling behind. So what exactly are stablecoins? How do they work? And how can you use them in your everyday life, safely and smartly, in 2025? Let's break it all down. A stablecoin is a type of digital currency, but unlike Bitcoin or Ethereum, it doesn't bounce around with wild volatility. Why? Because it's pegged to a real-world asset, most commonly the US dollar. Think of it like this: you hold a digital token worth $1, and tomorrow, it's still worth $1. That stability makes it useful in ways traditional crypto isn't, at least not yet. In 2025, stablecoins have evolved from niche to mainstream utility. They're used in international trade, DeFi savings, payroll, and even for buying groceries in some places. And behind the scenes, a massive battle is brewing. Central banks, tech giants, and crypto startups are all racing to control this new layer of the financial system. This isn't just innovation, it's disruption. It starts quietly, a single click, a tap of your thumb on a screen. In a world spinning with financial complexity, rising inflation, volatile currencies, collapsing banks, there's one thing that suddenly feels simple: sending money. Not through banks, not with delays, not across tangled borders with fees stacked like bricks. But with a stablecoin, you blink, and $100 in USDC or USDT has traveled thousands of miles, instantly. This isn't science fiction anymore. This is 2025. But let's take a step back. To truly understand what's happening with stablecoins today, you have to start with what they represent: trust. More specifically, programmable trust. Fiat currencies are backed by governments and riddled with inflation risk. Cryptocurrencies are revolutionary but notoriously volatile. Stablecoins promise the best of both worlds: the stability of fiat, with the borderless and efficient mechanics of blockchain. In 2025, the use of stablecoins has exploded. What started as a niche tool for traders and crypto nerds has now crept into everyday financial life. And if you zoom out, it becomes clear that something enormous is happening. Not in the headlines, not in Wall Street boardrooms, but among everyday people. In Nigeria, stablecoins like USDT are used by small businesses to protect their earnings against local currency devaluation. In Argentina, families buy USDC on Telegram just to preserve the value of their monthly wages. In Turkey, stablecoins have become the middle class's savings account. And in the United States, it's beginning to look like the next generation version of Venmo, but more powerful, more universal, and far less dependent on banks. The foundation of this surge isn't just economic, it's technological. The infrastructure around stablecoins has matured dramatically. With the rise of Layer 2 blockchains like Arbitrum, Base, and Optimism, transactions that once cost dollars now cost fractions of a cent. You no longer need to know how to use MetaMask or read gas charts. You don't need to fumble with private keys or worry about bridges. The experience is increasingly like any other app, but beneath it is blockchain infrastructure. Take, for example, someone in the US who wants to send money to their cousin in Mexico. In the past, they might have used Western Union, waiting in line, paying a 10% fee, and hoping nothing gets lost. Today, they open an app like Coinbase Wallet, load up some USDC, and hit send. The recipient gets it instantly and can use local apps to convert it to pesos or even spend it directly. This isn't just convenience, it's empowerment, it's financial freedom. Now, here's where it gets interesting. Because stablecoins aren't just being used for peer-to-peer payments, they're quietly becoming the plumbing of a new digital economy. Think about freelance work. On platforms like Braintrust or Upwork, contractors from around the world are now being paid in stablecoins. A designer in the Philippines completes a project for a client in London and gets paid in USDC, bypassing PayPal's delays and fees. The money hits their wallet in minutes, not days. It's settled, it's final, and it's usable right away. Meanwhile, e-commerce platforms are integrating stablecoin checkout options. Shopify and Stripe have begun experimenting with USDC payments, especially in cross-border contexts. For merchants, it means faster settlements. For customers, it means instant transactions, even on weekends. And don't overlook decentralized finance. In 2021, DeFi was all about wild speculation, yield farming and rug pulls. But in 2025, DeFi is increasingly built on stablecoins. Platforms like Aave, Compound, and newer protocols like Athena or Sommelier are offering dollar-denominated savings products. These aren't scams. They're real alternatives to savings accounts, offering 4% 6% APY on stablecoins, backed by transparent smart contracts and open liquidity pools. People aren't using stablecoins because they want to speculate. They're using them because they need stability. Even institutions are getting in. In fact, Visa and MasterCard are now settling some transactions in USDC on Solana and Ethereum. JP Morgan Chase has its own internal JPM coin running on private blockchain rails. And the US government? It's been working on its own central bank digital currency, though progress remains slow and heavily debated. But while governments delay and debate, people are already acting. And that's where the real story lies. The average person, from Lagos to Los Angeles, is learning how to custody their own money. How to move it without permission. How to earn yield, pay bills, invest, and save, all without touching a bank. That brings us to a more subtle, but powerful trend: self-custody and personal finance sovereignty. It used to be that people handed control of their money to institutions, banks, credit card companies, investment firms. But as trust eroded, due to inflation, banking crises, and privacy breaches, more and more people began taking control back. Not everyone storing seed phrases in metal plates, but with tools like smart contract wallets, account abstraction, and social recovery, custody is becoming safer and easier than ever before. And when people realize they can send, receive, save, and even invest in stablecoins with nothing but a phone and an internet connection, the paradigm shifts. Suddenly, being banked or unbanked no longer matters. You're just connected. Still, this revolution isn't without risks. Regulatory scrutiny is mounting. The SEC continues to scrutinize stablecoin issuers, particularly when it comes to reserves and audits. Circle, the company behind USDC, has bent over backwards to prove its legitimacy, publishing attestation reports and working with US banks. But others, like Tether, remain controversial, with transparency still in question. Then there's the geopolitical angle. Stablecoins, especially dollar-backed ones, are quietly becoming tools of soft power. When someone in Venezuela or Iran opts to store wealth in USDC instead of their local currency, it extends the reach of the dollar in ways central banks never anticipated. Some governments see this as a threat and are cracking down. Others, like Singapore or the UAE, are embracing the change, hoping to become crypto-friendly hubs in the global economy. But here's what no one can ignore: stablecoins are becoming indispensable. Whether you're an immigrant sending remittances, a Gen Z investor saving in dollars, a small business hedging currency exposure, or a DAO managing payroll, stablecoins are now the glue between the old world and the new. The fiat bridge that lets you walk safely across the volatile terrain of crypto. And with each passing day, the on-ramps are improving. Platforms like Ramp, MoonPay, and Stripe's crypto APIs now let people buy stablecoins with Apple Pay or a debit card in under a minute. Off-ramps are improving too, with fintechs allowing users to convert stablecoins directly to fiat or spend them with Visa cards. In this new landscape, financial literacy is becoming digital literacy. It's no longer enough to know how to balance a checkbook. The financially savvy in 2025 know how to bridge assets across chains, compare smart contract yields, and spot custodial risks. Yet even if you never touch a smart contract, stablecoins are affecting you. They're driving down remittance costs. They're forcing banks to innovate. They're creating competition for savings. And soon, they may be powering everything from gig economy wages to government relief programs. It's the quiet revolution you didn't see coming until now. So what happens next? We're seeing experimentation with algorithmic stablecoins, not like the doomed Terra Luna project of 2022, but newer, more sophisticated designs like Athena's synthetic dollar or Frax's hybrid model. These aren't fully trusted yet, but the groundwork is being laid for decentralized, collateral-backed stability that doesn't rely on any single company or government. Meanwhile, interoperability is becoming real. A user might earn USDC on Solana, spend it on Base, save it on Optimism, and withdraw it through a bankless ATM, all in the same day. Wallets are becoming smarter, integrating swaps, bridges, and yield, all in one interface. Eventually, stablecoins may become invisible. You won't say, "I paid in USDC." You'll just say, "I paid." The stablecoin rails will hum quietly under the hood, instant, cheap, borderless, always available. Like email, like the internet itself. And maybe that's the point, not to make stablecoins famous, but to make them boring, trustworthy, ubiquitous. By then, the question won't be why use stablecoins. It'll be, why would you use anything else? This is the future of money, not built in marble halls or bank towers, but in code. On-chain, in your hands. Welcome to the stablecoin era. Here's what's happening right now in the stablecoin world. Visa now settles over $3 billion in stablecoin transactions monthly. Yes, billion. Circle, the issuer of USDC, just partnered with Shopify to allow direct stablecoin checkout on over 2 million stores. Tether is expanding into tokenized real estate and gold, pushing beyond just dollars. The U.S. Congress passed the Stablecoin Regulation Act in early 2025, forcing full transparency for all U.S.-linked issuers. And meanwhile, emerging economies are integrating stablecoins into national payment infrastructure, turning crypto into public infrastructure. What started as a workaround has now become the backbone. Stablecoins aren't a buzzword anymore. They're not just for crypto geeks or DeFi degens. They're money, real, usable, digital cash, backed by trust, speed, and innovation. In 2025, if you're not at least learning how to use them, you're already behind. Because while the old banking system creaks forward, this new world is moving fast. Borderless, frictionless, permissionless. So whether you're protecting your income from inflation, paying a freelancer overseas, or just trying to save a little smarter, stablecoins give you power in your pocket. This isn't the future, it's already here. The only question is, are you ready to use it? Thank you so much for spending your time with me today. I really appreciate you watching. If you found this useful, a like would be fantastic, and subscribing helps me keep creating content you'll hopefully enjoy. Please share your experiences and any questions in the comments. I always try to read and respond. Your support keeps this channel going. Until our next video, take care and have a wonderful day.